Hey, everybody. My name is Mike Johnson, and this is the Success Estate Podcast. Thank you so much for your time checking us out today. My goal is to not only give you some information, but hopefully having an interesting conversation. And today I've got a great person here to talk with us, kind of give us his insight, tell us some things that are going on with him, and overall just talk about the market. Today I have Mr. John Nustad. Nustad.
Yeah.
I've been saying that wrong.
I don't know.
I've been telling a lot of people, John Nustad.
We pronounce it wrong because we Americanized it.
Okay.
The actual way to pronounce it, I can't even say it. So,
Really?
Yeah. It's Norwegian. So.
Norwegian.
Yes.
Oh, that's interesting. Okay, so you have your family, are they immigrants or what do you?
So it goes back, I don't know, like maybe great grandparents.
Mm-hmm.
And they settled in like on my dad's side of the family, it's California.
Yeah.
So they were in California, and that's just kind of where it is. But
Got you.
Yeah.
But where are you from? Where'd you grow up?
so I was born in California.
Mm-hmm.
And
Which
then,
part of California?
So I'm born in Artesia, California.
Oh, shoot.
So suburb of Los Angeles.
Yeah.
All right. And then my brother, he was born a year after me, and he was born and I think it's like called Crystal Falls or something like that.
Okay.
And it's basically the Mojave Desert.
Oh,
so
really?
Somewhere around
Interesting.
that area. And then we were there till I started school when I was kindergarten when I was there. And the interesting thing about California is you can start kindergarten when you're 4 years old.
Oh, okay.
And they did, at that time, now I think they have Head Start.
Is there a test for that or something?
I don't think so. No,
You
I
just
think
decide?
they just allow you to do that just as a way to give public education instead of having to pay for daycare.
Sure.
So it's an option to just parents that they can
Sure.
use. And I think the year after I went to kindergarten, I think the next year they rolled out for the state Head Start. So my brother ended up going to Head Start. So he was able to do that instead of starting school early like I did.
Interesting.
So it made me the youngest person in my class, and I was going to college by the time I was 17, even though I went through all the school. So that was the interesting part about it.
Wow.
And then when my parents divorced, we ended up moving to Gladewater. And so I went to Gladewater School, and then we moved to Longview and went to Doris McQueen.
Oh, really?
So I went to Doris
That's where I went to
McQueen, or
school.
Johnson McQueen now.
Yeah.
And went to Doris McQueen, and then we ended up moving to Pine Tree area.
Oh, man.
And so 3rd through 8th grade, I was in Pine Tree, and I went to high school in Gilmer. So I went to high school in Gilmer and graduated from
You got a
Gilmer.
little taste of the best, at least.
Yeah.
You know, you got a little taste of the best. I always, of course, anybody not from Longview, I always give them a hard time. Just because all the surrounding areas are great. Pine Tree is great, but I always think it's going to be second best. That's just my personal opinion. I bleed green. I went to school at Doris McQueen. Grew up right down the road. Moselle Johnston, who they combined, Judson Middle School, all the way up to Longview High. So I'm a Lobo through and through.
Yeah.
And I heard you say go Longview earlier, so we'll let you make.
Hey,
Now, do you watch any? You get a chance to go
Longview.
back and check out Gilmer or anything like that?
So Gilmer, I was lucky when I was there. That was the start of the whole Gilmer dynasty, that part. So,
Sure.
Coach Traylor came in 2001, I guess, and really changed the football program there. I didn't play football.
Yeah, okay.
I lettered in basketball, track, and cross
really?
country. Yeah.
Okay.
I was, like I said, I started school when I was 4, so I was small.
Yeah.
Compared to, so football was not in my
I'm about to
cards.
say, oh man, you're always going to be, genetically. I mean, not genetically, but as far as your growth, always a little bit behind.
Yeah.
Ahead in the books, but behind in your growth.
Yeah, it was great.
In comparison.
It's great. It gave me a lot of confidence, and I was actually telling somebody about this today, but because her child was the youngest in the class, and because I started that way as the youngest, I felt like I was their age.
Yeah.
Even though I wasn't, until you hit puberty, that's when you start. There's like you're trailing, you're a little bit behind on that thing. So,
right.
8th to probably 7th, 8th, 9th grade, maybe at that point, it's kind of trailing, but then you kind of catch up.
Yeah.
But what was great about it was I played City League. And so when I played City League, I played kids my own age. But I am a grade or two higher than them.
Right.
And so I dominated in City League.
Yeah.
So that boosted my confidence.
See, and that's so funny because we have 2 first cousins that my little brother and I played with growing up. My older cousin, he's about 2 years older than me. His brother is born a week ahead of me. So in order to even things out, we would always play my older cousin and my little brother, who's 3 years younger than me, against me and my cousin that was a week apart, and they dominated us.
Mm-hmm.
And my brother, I remember watching him, because I would always end up, I was a little better athlete than my other cousin, so I would take the bigger cousin, older cousin, and my little brother would, I mean, he would just demolish my cousin.
Mm-hmm.
And I love you, Jamie. I love you. Birthday just passed. I love you, man. But yeah, Aaron used to give him the business. Now we get to third grade. He gets into third grade, and I see him go into sports. And we had been playing. He'd been playing with a kid 3 to 5 years older than him all his life. Now the speed of the game is just different for him. So he was just, I mean, he was dominant. That people were wanting to check his birth certificate and things like that. And as I saw him get older, it wasn't even a surprise that he was able to lead Longview to state 2 years as a quarterback, because he just, I mean, his progression, he was just always ahead. You know, even when people started catching up physically, he was already ahead because he was so aware of the game. He had started to transform and things like that. So I often wanted to put my children up a little bit.
Yeah, haven't played up higher level.
Even if they get beat, it's like, hey, take your losses now. You know, because when you play against guys your age, it's going to be much easier for you.
Yeah, I mean, it shows that he had grit from early on. Because
Exactly.
the fact that he's willing to play somebody older and just keep coming back, even though he is getting dominated, just allowed him to further just strengthen his resolve.
Right. And
it reminded me, like, so I lettered in cross country, and I ended up going to regionals in cross country, and this was my freshman year. And so I was 13 years old. And so I'm 13-year-old running against varsity.
Whoa.
Okay. And so, but at Gilmer at the time, where we ran was out at it was called Dean Lumber at the time, but they had land out there. Anyways, it was the hardest course in the entire district. And so every day I trained at the hardest course.
Yep.
And so therefore when I ran the other courses, they were easier. And so that constant ability to, when you're practicing and training and you're doing it under those circumstances of harder situations, it does make it better whenever you have to compete against.
What makes a cross country what makes it difficult? What makes it the hardest course? What would
hills, terrain?
Hills. That's okay.
Yeah, you're talking about elevation changes.
Yeah.
So that's because they're all going to be the same distance. They're
Gotcha.
3.1, 3.2 miles, whatever the case is. They're going to always be that distance, but the course and how flat it is is going to be the difference.
I know we jump right into everything, and but I also too want to acknowledge married man, 2 children.
Yes.
Do you ever kind of staying along that while talking, about you and your wife? Do you ever desire to push your children, or is it hard for you not to shield them from some of the hardships that you may have went through in order to, try to propel them?
So I'm a big believer, and I'm not trying to protect my kids.
Sure.
I want to prepare my kids.
Yeah.
And if you do that and you go through that standpoint, no, I don't care what situations you go through. I care about how you handle those situations more so than anything.
Yeah.
So, no, I mean, I'm all about giving them, challenges and things within their control, within a safe environment and a safe and loving environment, and allow them to have that ability to fall back on, a foundation.
Yeah.
But overall, we always want to give our kids better than what we ourselves had, but I'm more concerned about making my kids better than I was.
The question is, what is better?
Yeah.
I heard a quote that said, tough times create strong men create easy times, easy times create weak men create tough times.
Yep.
So, and when I thought about that, I was like, okay, so what is actually good for my children? Is it to make the path easier for them? Or do I need to manufacture a path where they, they experience some hardship, so that way they have to figure out how to, do I need to go drop them off in the woods and say, find your way home,
walk the 10 miles
just
to
be
school.
following them and follow them home, make sure nothing happens to them, but, let them figure it out. Like, of course, that's a crazy example, but I oftentimes think about those things. Like, how can I make things not too easy for my children where they don't learn, to stretch their wings, where they don't learn to use those muscles. I realize that it's really a fine line.
Yeah, it's a hard balance. And, again, and that just comes to we have that ability that we can think about that choice.
Sure.
Because like a lot of kids, whatever the case, or even my own drinking, it's like sometimes those things are forced upon you, and you really have no other alternative on
Sure.
that.
Sure.
Again, I would just say I would focus on how, and like just make sure, okay, like I don't know what's going to happen, but how you respond and how you can do that,
Sure.
different things will help. And so I focus mostly, maybe not, since we don't have the tough situations, I focus on the character and, Christian morals. Are you, I really don't care. Are you kind to others? Are you, helpful? Are you serving other, are you doing those kind of things? And then are you doing that with a positive attitude, and that you, no matter what it is, you don't give up. You've agreed to this, you've committed to that, and you have to uphold those things. And I think if you have that strong foundation of those kind of support, the situation, they'll come to what we taught them, and use and utilize that. So.
Sure. Moving into, I would assume we, of course, I've known you for a little while now. I assume you kind of take those same things into your business. You will tell everybody, who you're affiliated with, and what you do exactly for.
So my name John Nustad again. I'm with Guild Mortgage here in Longview, Texas, and so I do residential mortgages, and so I help people become homeowners or to refinance to get better terms on their current existing, and it could be anywhere from primary residence, second home, to investment property. And then also within that, so you have the primary, second, investment, and then you have your, trying to blank on what word I want to say, residential side of it, as long as it's on that end. 1 to 4, 1 to 4 units is the word I'm looking for.
Sure. So
1 to 4 units. So it can be, it can be a multifamily in that situation. So sometimes,
right.
So we write to secondary market guidelines, and so we sell to conventional. So conventional like Fannie Mae, Freddie Mac, FHA, VA, USDA, those, and they consider basically residential 1 to 4 units.
Sure, gotcha.
So, yeah,
gotcha. And your career path. Let's talk a little bit about your career path. Tell me how you got started being in the mortgage industry.
Yeah,
tell me a little bit about that.
So, where do we start on that? So the main thing is I started out, my first sales job was working at T-Mobile. And I was in Las Colinas.
Oh, man.
And that was my first taste of sales. And I love sales because before that, I came from the food industry. And what I found was the harder I worked, I still made the same amount of money.
Yeah.
And
they put the cap on you.
Yeah, and so somebody who's maybe a little bit on the perfectionist side, or even a high achiever, or that have a strong work ethic, you sense a lot of unfairness in that. And it's like, I'm doing all this, and then this person's not. And so I get
we're still at the same level.
You're still same level, same, yeah. And I was managing a restaurant, and I was the youngest manager in that franchise history. I was only 18, 19 years old, and I was fully running the restaurant. And I ended up having the best year that they've ever had.
Wow.
And so we did that. We had the best year ever, and I didn't get anything for it. Like, I got like
a pat on the back.
I got like an attaboy.
Yeah. Keep it up. Make me some more money, sir.
Yeah, make more. So I was like, why am I working so hard? And I loved it. I loved what I did.
It's not bad for some people. That's good.
Oh man, it was the best. I mean, it's the best character building, and I learned so much doing management. And the first, those years that I was doing management in the food service, I was learning. So the pay wasn't there, but when I first got into sales and I started selling for T-Mobile, I was like, man, this is awesome. Like, I mean, it's like a light switch. I mean, the harder I work, they had to like pull me off the sales floor.
Wow.
And like they said, you have to go take a lunch break. I'm like, I'm clocking out, but I'm staying on the floor.
You want to miss that money?
And so I want to be here at all times. And so that was my first indication of sales. And then I went into management with them, and I was the youngest store manager they've ever had. And I had I was only 23, maybe 22. Became a store manager of a brand new location for them. And did that, and I realized that to me, like, I didn't like sales management. I was very much about like I wanted to go out and still,
right,
do the work.
Yeah,
so,
be interacting. Yeah, sure.
Yeah,
sure.
I didn't get the enjoyment of the development
right.
as much as I did my own personal development.
Right.
So that made me look at it. I was like, okay, well, what kind of job can I be customer facing? Because I realized like I needed the customer facing side of things. and that I'm in sales and that I can help people and do things that I believe in. So at that point, that's when I decided, okay, well, I'm going to get into banking. So I started with Chase with them, did that, and my goal was to be financial advisor with Chase. So JP Morgan was the best. So I was like, I'm going to go there, do that. I get into financial advising, or not financial advising. I get into wealth management with them. And so I started doing wealth management with them. And then at that point, I started to realize like the industry was changing. So they were changing it to where the big thing was like fiduciary was the big thing.
Oh yeah, yeah.
And they were changing it. And what happened, the intention is great. And I feel like we should all be acting as fiduciaries.
Right.
But what happened was these big brokerages like JP Morgan and Merrill Lynch and some of these others, like they took away our ability as to basically provide advice because they were concerned more about getting sued.
Right.
That fiduciary, because they can't control like it's hard for them to control what that individual advisor's promoting or pushing. And so they kind of took that away and they pushed, managed and packaged stuff. And then I realized like I was really at the whim of how good they did. And so, they're always looking at year over year performances. So if they had a great year, then I would have a great time, being able to sell historical performance. If they had a terrible year, I'd have a terrible time of selling historical performance. And so I didn't like the fact that I didn't have control over the performance.
Sure.
And so that's kind of when I transitioned. I was like, okay, I want to go into mortgage lending. And mortgage lending, we know what the terms are. So if you tell me, hey, I want to buy a house, I'm like, okay, great. Like, here's what the interest rate is. Here's the amortization. Here's how long to pay off the loan. Here's what it is. And it's fixed. A lot of times it's fixed rates, but here's fixed at the life of the loan. Both sides of the table knows exactly what the other person's getting.
Right.
And investments, you can't do that. Like I can't guarantee you what tomorrow's going to do or the next year or 5 years or 10 years in the market.
Sure.
And so I like that idea of it. So that's how I got there. But then I was 1 year in mortgage lending with Southside, and then I switched over to commercial lending.
Gotcha.
And I was in commercial lending for 3 years with them.
When was it that you switched back to residential?
So in April. So I went back April 2020.
April 2020. So mid pandemic.
No, the pandemic just started. So
So
March.
Yeah. Oh yeah, because it was March and then okay.
Yeah. So whenever. So there's a lot of things I liked about commercial lending. A lot of things I didn't like. A lot of things I didn't like about commercial lending. And so I kind of was already kind of getting where I wanted to kind of go back to mortgage lending because I like having the guidelines, and as long as I've met within those guidelines and the person I'm trying to help we can check all the boxes and do all that stuff. You can't tell me no. Like we can do the deal.
Right.
And so a lot of that's really the reason why I want to go back into mortgage lending. But the pandemic is kind of like that was the catalyst because I was like, okay, listen, the commercial is going to dry up, but I know that the Fed's going to step in, their operates. I know the housing is going to boom.
Sure.
And I was like, basically went to him and said, put me in, coach. Like, put me back into residential. And so then I went to residential.
Dust those residential sneakers back off. And
that's
did they actually see as big of a decline as you thought they would on the commercial side? Do you keep your eye on it at all?
I don't know. I'm sure 2020. Like, so before I left, and the reason why I started in April was because we had the PPP loan, the Paycheck Protection that they did, and so I wanted to stay in commercial lending to be able to help those clients that I had and other people that in Longview and the surrounding areas that desperately needed those funds, and I was able to like really spearhead a lot of that, get very I was very involved and knew a lot of the different stuff, and I'm happy to say that everybody that I went to or that came to me to get help for that, I was able to provide the PPP funds for them. Nice. And it was a very stressful time because we didn't know. They basically threw out there not very much guidelines and stuff like that.
Right.
But I was thankful to be able to do that, and so I'm sure the rest of 2020 it kind of dried up and then maybe even first half of 2021. But I think after that, I would say it probably went back to normal because the commercial bases, their rates kind of off of prime to an extent.
Yeah.
they do it off prime, or they do kind of like with mortgages where they base it on the 10-year treasury yield.
Right.
Both of those came down dramatically, which helped spur investment in people.
And all of the that. So you kind of had the foresight, seeing like, hey, I'm seeing how this is transitioning.
Mm-hmm.
I need to make a change to keep up with. Well, not keep up, but more for one to get you back in line with what seemed like some of your values as far as how you like to serve people,
Mm-hmm.
and then also to feeling like there may be more opportunities on the residential side. I tell everybody it's so weird. I remember so I went full time at the very end of 2019.
Perfect timing.
And right after, so I was at a nonprofit. We lost the funding for my position, so they had to let me go, and I was in prayer trying to figure out like, okay, what am I going to do next? And right after I made the decision, okay, I'm going full time. I remember kind of watching the wave of COVID in China in December, and I went to my wife and said, hey, this is really weird. Like, this something feels, it feels a little ominous to me, And I was concerned because I just went full time, and then in that following late January, early February, I'll never forget. My wife was sitting on my son's bed. I went back there too. I said, hey, I think this is real. I think this is going to make major changes for us. I think we need to prepare ourselves, try to keep, as much income in the home as possible, just prepare for whatever. I don't know what will happen here. And then, of course, March comes around and boom, everything shuts down. I literally was like, oh, man, I picked the worst time I thought that, my limited knowledge of the housing industry and everything at that time, just going full time, dilly-dallying for the past 2 or 3 years, so I'd been picking up steam, and everything totally surprised me. Mm-hmm. Of course, when the feds dropped the rate, I thought that people would say, okay, I'm not going anywhere. I'm going to stay here. I'm not going to try to move around at all. Even people that were renting, my mind was completely blown, of course. So the past 2 years, home price values, all those skyrocket. How was it on the lending side for you? Did you experience my boom happened pretty quickly. Mm-hmm. From March to May? I got an influx of buyers, people coming in. The interest rates have started to drop, and I was surprised by how much business that I was able to garner in 2020, at the beginning of 2020. What was it like for you? Did you experience a pretty big boom?
Yeah,
or
it happened. As soon as I got in April, it was, we were busy.
And this was at Southside?
I was at Southside, at the time. Yep. So, it was busy, and it happened really quickly. And I a lot of it is due to the fact that like they did the PPP thing, and then I knew based on the success that they had in 2008 of 2009 with quantitative easing. So Bernanke at that time dropped the rates, and that helped to spur some growth. And so I knew that the Fed's playbook, like that was going to be something they were going to be really fast to go to. Yeah. And so I knew the rates were going to move down real fast. So
did you think that it would get to where it was?
Yeah.
The low twos.
Probably not the high twos. I didn't think it'd probably get there, but the threes definitely. Yeah. Like I knew that was probably it was going to be a very high possibility I was going to get there. Mm-hmm. But yeah, I didn't. Being down there that we're getting into the twos, that's a first, and so I didn't expect that. Sure. Besides, do maybe a 15-year.
But for me, as good as it got, it got too good. Mm-hmm. To a point where there were so many people getting approved for so much money, and so few people wanted to sell their home. Surprising. I was surprised by that earlier on. At end of 2020, early 2021. People could kind of see how things were starting to shake out. Like, hey, if I sell this, I got to turn around and buy something. It's going to be difficult. I can understand that. Early in 2020, it felt like there were a lot of people that didn't move. Of course, we were early on in the pandemic. That made some sense to me. Like, hey, I don't want to just get out of the house at all. I knew a lot of people that just didn't want to get out of the house at all. But I was surprised how quickly the competition rose to where this good thing, this interest rate being low, the opportunities that were presented, how difficult that got to get in there and negotiate, and you really didn't have much negotiation. You know, at one point I remember just being like, hey, pretty much this house over here is sold for $10,000 over. I think you're probably gonna need to offer $11,000 over what they're asking if you're gonna be competitive. You know, that's what people are gonna be expecting in this area now. You know, and it got to the point where it was like, hey, whoever can bring the most cash wins. You know, how was it, you know, for you as far as, I know you probably got an influx of buyers coming in, applications probably rose, but did you see a lot of those actually be able to purchase, or did you have a lot of people that wanted to buy but couldn't just because of the competition?
Yeah, so my situation a little bit different. So what happened in April 2020, I'll go back into mortgage lending. The first stem of that, the first boom of that is going to be the refinances.
Sure. Oh, yeah.
So we were doing that was pretty much most of the business was refinancing, and that was, I mean, that's the refinancing was by far probably 80% of what we were doing.
Jeez.
And then what happened come basically 1st of November, I ended up leaving Southside. I ended up going to another company that did it was a refinance shop.
Sure.
And they did refinances all over the nation.
Mm-hmm.
And so I was lending in 13 different states, I believe.
Wow.
And so I worked that whole work from home boom that came from that COVID.
Mm-hmm.
So my wife was already working from home. So she was one of the very first people that started, you know, kind of, I guess, one of the few that was working from home before it got like everybody was working from home.
Right.
And then, and that was just part of her job, is remote. And then my job was remote. And so I worked from home. And so now I'm there doing that, and I'm doing loans all over the nation. And it was a great opportunity because I could do loans, you know, all over the East Coast is where I like to do it, because I'm an early bird. And so, I like to get up early. Yeah. I could start calling East Coast,
you
know, 7:00 in the morning.
Sure.
So I'd call the East Coast. And what was great about this too was, you know, East Coast homes are worth a lot more.
Yeah.
And so, and as an originator, we're paid off of the dollar amount. It's just as real estate people, as realtors are. And so,
my gosh.
So I'm doing loans. My average loan size is, you know, 2 or 3 times higher than what people are doing here. And so I took advantage of that.
Oh man.
And was doing fantastic. That and did that for a year and a half. And so, I mean, I pretty much did 95, 98% refinances during 2020, 2021. And then when it started changing, I started seeing that, okay, we're going to switch to a purchase market.
Sure.
And so I was like, I need to get the refinances are drying up. So I started looking, and I was like, okay, so I want to do, and what I really want to do is local stuff. I want to do stuff here. I want to help the community that we're doing here. And so that's when it made me settle with Guild. Like, I was like, okay, who's the best at what they do? Like, what company is going to be here that can help the most amount of people? And like, you know, when I was at Southside, and a bank is typically, they're very limited on what they'll allow you to do, because they're just more conservative. They're not a preferred or direct lender of, especially government loans. Right. So like FHA, VA, USDA. Mm-hmm. Well, FHA, for instance, is the most common for first-time home buyers and other people. And so I was like, well, what's going to open up the most opportunity for me to help the most amount of people? And that's the route I went. So Guild, they have a great team there, and they're knowledgeable, and they
definitely
most production around. So
definitely. And you know, as far as, you know, I've done several deals with Guild at the helm on the lending side. Tom always does a great job. I always appreciate how responsive, you know, everybody there is. Being there now, do you see a big change or anything coming? I guess let me say it better. Do you have any predictions for what we're about to experience moving forward? I know we just talked about the past couple of years. Do you have any predictions for what we're going to see moving forward?
So these are, of course, are my opinions.
Sure.
And so,
let me jump, because let me say this. I'm putting you on the spot. If you want to do a prediction, you're great.
No, I'm fine with that.
Honestly, I'm gonna give you my position. I don't believe anybody knows.
Yes.
I'm laughing so much at all the people that were like, "Oh, the market's crashing, all through the third quarter of last year." As soon as third quarter here last year, I saw a ton of YouTube videos. Get ready, the market's crashing, and I'm looking around. I'm like, I've never seen a crash like this before.
Yeah.
And they'll continue. I like to listen to like Patrick Bet-David, and I've been hearing him ringing the bell, for a long time. Grant Cardone, a lot of these people ringing the bell. The market's crashing. And I'm not saying that it won't happen, but they made it sound as if, hey, this is about to happen.
Yeah.
Get yourselves ready. It's about to crash. Everything's about to fall apart. People were talking about how home prices have started to fall, and I told when I talk to the everyday lay person about the housing, I tell them, I say, yeah, the sales prices may be falling, but the home values are still ridiculous.
Mm-hmm.
The home values are way up from 2019. So I'm not understanding what a crash is. If you see a dramatic fall, to me, you haven't even fell back to normal. So what's the problem? How is that a crash if we're not even falling back to where we were before the pandemic? So I say all that. You're more than well. I don't have a big prediction. I can't. It's just too many variables for me. But of course, if you have thoughts on it, love to hear it. Love to hear what you think.
So I'm pretty confident on.
And we'll hold you to this.
That's perfectly fine. So, I have a unique experience in the fact that I've done wealth management, I've done commercial lending,
Sure.
I've done residential lending. I didn't know the extent of COVID. I didn't know that. I honestly didn't think that would ever be a major thing. I saw China dealing with it, but I never thought, oh, that's that's China. And so I was wrong in that sense, and I never would have been, and I would have been wrong with how extreme it got. What I wasn't wrong with was the economic side of it.
Sure.
So I knew the writing was on the wall. I was like, listen, I know that there's going to be a housing boom because of this, because the rates are going to drop. And the reason is again, going back to 08, 09, the Fed quantitative ease dropped rates, which then caused that. Now, 08, 09 was much harder to do, and there was actually a crash because the reason why 08, 09 happened was because of the systemic issues with the mortgage industry at that time.
Exactly.
So you take away,
which we've corrected,
which they've corrected with Dodd-Frank and all that stuff. So
Right.
You're taking something that where the homes make up like 20% of the GDP.
Right.
So housing makes
Right.
up a huge portion of the GDP. So now you got 20% of GDP that's under distress. It's going to cause a much greater ripple, and it's going to
Sure.
take longer for you to come out of that. In the sense of COVID, they were very quick to respond. They were quick to get the money out there into the hands of the businesses, into the people, to protect jobs and things like that. Could they have done a better job? There's always that sense of things. But at the time, I actually predicted. I was like, once it happened, I was like, the S&P 500 will be back to where it was within 4 months. I was like, it's going to be back there, but.
Did you write that down anyway?
I did. It's on social media.
It's on social media. Okay.
Now
you got the receipts.
But I was wrong because it was within 3 months.
Oh man.
But my biggest issue, if I had to say anything, I'm a permeable. So
Sure.
I'm always optimistic.
Sure.
I always believe that things are always gonna be better. And and that's because I'm a contrarian too. Because when things are bad, that's when you want to. The famous saying, when there's blood in the streets, that's when you buy. So to me, the contrarian in me always looks at the silver lining, like this is bad right now, but it's going to be better.
Right.
And so what happened with that?
So you're an optimist.
I'm always an optimist.
Gotcha.
Probably I could use a little more pessimism, probably.
Yeah, a little dose. I'm about to say, because you don't sound like a contrarian.
I'm a contrarian because to me, I also stock pick and stuff like that. Like I like things when it's out of favor with everybody else.
Sure.
And to me, that's the opportunity to make the real money is when everybody else is doing it. Then now, here you are, the people that bought, some people that bought in 2022, early 2022, in more metropolitan areas,
right?
They're finding themselves kind of underwater because they got kind of caught up in all the hype, and all that stuff. And with us, it's not, even though the metropolitans, because they ran hotter. So when you run hotter, you kind of tend to fall hotter.
Sure.
We never really ran so hot that we ran out of where there was affordability issues.
You said we. What do you?
Like we as in East Texas.
Got you.
Like the Longview and the greater area. And the other benefit of us is that we are very oil and gas heavy. And oil and gas boomed.
Right.
And so since we're so much of our GDP, our economic is based on oil and gas, it makes us more resilient than these other markets that are maybe relying more on something like tourism or something like that, right? So with all that said, with all that prefaced, what I believe is going to happen is and I can say this was with pretty good certainty, with barring some sort of shock to the system, unknown deal, is what happened is inflation rate. So you have inflation, okay? And so inflation typically runs, 2 to 3% around that area, okay? So if inflation's stable, which we were, and then you have above that, if I'm going to invest, so if I put my money in the dirt and inflation is 2%, I'm going to lose 2% of my money every year towards inflation. Okay.
Gotcha.
So then what I need is to buy an investment. So the most safest investment you can buy. Go ahead.
When you say in the dirt, you're just meaning holding on to your. You got your cash, put it in the bank, hold on to it. It's losing value.
Yeah, you're putting into a checking account or a very low yield savings account, something like that, right?
Yeah.
You're losing 2% of your money to whatever the inflation rate is. You're losing your money to that.
Sure.
Now, so if you're an investor, what you're going to do if you want safe money, so you want, CD, savings, the next safest thing up above that is a treasury bond. Okay. So then that's when you buy treasury bonds.
Yeah.
And treasury bonds will pay a yield that's going to be typically above the rate of inflation, because if you're going to put some money, you're going to put your money at a little bit of risk, you want a little bit of better return.
Sure.
So that's why they do that. Well, the next safest thing above that is a mortgage-backed security on a primary residence. Okay. And that's what we do, right? So we're basically taking the loan, we're selling it to Fannie Mae, Freddie Mac, FHA, VA, USDA, right? They're taking they're taking those and they're selling them to investors as mortgage-backed securities.
Right.
Well, the investor, if I'm an investor and I'm taking on risk, a little more risk, I'm going to want a better return than the treasury yields, right? So that's your margin. That's your difference in there. All right. What happened was inflation catapulted, like it went up, shot up, and that where you normally would get more money on your treasury yield and on your mortgage-backed security, now you find yourself where inflation is higher, it's inverted, and inflation's higher. So what's happening? So what's happening is rates are chasing that, because as an investor, why am I going to invest in a mortgage-backed security at 4% when inflation's 8%? It just doesn't make any, so rates chase that.
Sure.
And so they've been chasing it. Now we just had the inflation report come out, and inflation was at 6.5%, where we were at 8%.
Right.
So it's coming down. Rates have kind of chased that, right? Mortgage rates are in the mid 6s to mid 7s.
Did they just drop a little bit?
They're dropping, and you can. I mean, it depends on what product you're doing and everything. But right now you can be in the 6s, and if you're paying points and different things like that affect it. But we're kind of right where inflation is. So with inflation dropping, though, I'm not expecting rates to go up. So they're going to start kind of staying where they are while inflation drops. And so where I feel like the market's going to go is inflation's a peak. I mean, rates have peaked on interest rates. So with that, we're on the precipice of falling rates. So we're going to get there. And the question then,
how long do you think?
That's the question. So time.
Okay. Sorry.
So the more you string, the more further out you project, the much easier it is to be accurate. Okay. So if you tell me what rates are going to do tomorrow, I can't tell you.
Sure.
If you tell me what they're going to do in a month from now, or 6 months, or a year from now, it gets more hazy. But if you go out further, let's say 5 years, then it gets easier to predict, right?
Sure.
But with that said, inflation rates are coming down. So the question is, when does inflation hit 2 to 3%? When inflation hits 2 to 3%, then we can expect interest rates probably to be around the fives, somewhere around that. And then if you look at like a healthy rate environment, let's say between 2017, 18, right? We know that rates will probably settle in around the upper fours, around that area. Okay.
Sure.
So I think we'll be there. and we're heading that way. How quickly? I mean, we could be there as early as probably second half of this year. Not likely. More than likely, we're looking at 2024 of being where the rates are at that point.
Sure.
So I think we're going to experience a refinance boom. Everybody that bought in the latter half of 2022 and early part of maybe 2023 are going to be refinancing at that point. And so that's where the next cycle is going to go. And so I would say right now is the time to buy because as rates are higher, because you don't have all the competition.
Right.
You're getting it to where the sellers are a little more willing to give concessions to it. And so to me, I'd always buy it.
And that's actually where, where people are coming to me right now, asking if this is a good time to buy and things like that. I preference everything with saying, hey, I think the length of time that you're going to plan to be in your home is going to make a big difference. If you plan on, the old, hey, I'm going to buy a house, live in it 2 years, turn around, sell it. It's like, that's just not for the past 2 years throughout the pandemic. I actually had one guy I can think of for sure, when he came out and told me, hey, we've been looking at houses for a while and things like that. He finally came out and told me, like, hey, man, I probably do this. And I moved to the Dallas area and, sell this one, hope to make a little profit off it. I had to tell him I stopped him. And we were right up the street from where I live looking at a house. And I said, hey, man, I'd love to sell you a house, but this is not the time to do that. Like, you're gonna find yourself in a difficult place, I believe, if you turn around and look in 2 years and hoping these prices are gonna stay here. There's just no reason for them to stay that high when interest rates are gonna rise and people start getting back out and about and more houses hit the market. We got inventory, all those things compile together. The prices, they're gonna have to come down some. I don't think it's gonna come way down. I think, people are going to, it's a new taste in the mouth of buyers as far as what to expect, how much a house should cost. And so, kind of moving forward, I'm telling people, hey, if you're going to buy a house, now, as long as you staying in it for a little while, you don't plan on like, hey, I'm going to try to turn around and flip it. I think you're actually in a good place because let's say you buy a house now and your interest rate 6.5%, almost 7%. In 2 years, those rates drop. You come back and refinance. If you buy a house that's well within your affordability, which when I mean affordability is like, hey, are you still able to save, put money towards things that are important, and this home fits in your budget? If you buy a house at this at that affordability range, and you turn around and then you're able to refinance, bring the interest rate down some, you're probably going to save some on your monthly. So moving forward from there, you actually, I feel like you're actually going to be in a better position moving forward. You may have to, push it for the next couple of years, but I think you'll be able to come back around and find ways to save some money in the next couple of years. What do you think about that?
Yeah, I mean, of course, like if you're however short you're going to be there, it gets a little, again, less easy to predict. You don't know what's going to happen in the short term. And then you also, there's closing costs associated with buying a house. And so, yeah, you may have a cheaper payment than you would if you rented. But now if you factor that closing cost in there over that 12 months or 24 months, now you got to pay. I mean, that includes that. So then you have that without the easiness of like liquidity and movability, right? Like, so you got to calculate that in there, and people like that idea of that whole, I'm going to buy and price is going to be higher. It's going to be a while. I don't see that happening. I think what you're going to do is, like, normally a house appreciates about with inflation. And so you're going to see some appreciation in housing prices, especially here. I don't think they're going to go down.
Right. I
think they're going to stay steady, and they're going to start increasing maybe their normal 1 to 3% or whatever the case is, that they'll start appreciating that way.
Yeah.
I also do think that there's another force here at play that we've never had before, and that is the fact that a lot of these homeowners are sitting on a lot of equity.
Yeah.
So the amount of equity in the homes right now, which does a lot of different things. One is it allows them to, when they sell their house, it allows them to buy more house. Because they're able to put more down, or they're just in a better financial position to do so. And so you're going to have that. So the equity thing's a huge thing. And then also with that equity piece too is what drags down home prices a lot of times is a sense of urgency. So foreclosure, short sale,
Sure.
right? Foreclosures and short sales are down. I mean, they're ridiculously low. And because people have equity in their homes, they're not going to let the house go.
Right.
You know what I'm saying?
Right.
Where if you're underwater on the house, you know, sometimes
just get me out of here.
If it's not a moral or ethical issue, right, then you just do it.
Sure.
You just get rid of it.
Sure.
In this case, like with equity, and you're sitting on, tens of thousands, hundreds of thousands of dollars, you're not going to just let that thing go.
Right.
You're going to find ways
Right.
to either liquidate that thing
Sure.
or keep it.
Sure.
So without foreclosures and short sales driving down home values, I think we'll be steady and stable here, and I think we'll appreciate home prices at a normal, healthy rate going forward.
Yeah.
But yeah, 20% year over year gain, 30. That's not gonna happen.
It's definitely a new normal. I think it's been established. That for one, that people are willing to buy, especially when you compare with the rental rates right now. I mean, some of them are astronomical. And at first, when everything started happening, I was like, well, people are gonna start moving towards renting. But then I think landlords, they started realizing people got to have a place to live, and a lot of them aren't going anywhere now. This pandemic, COVID is going on out there. I can raise these rates and get away with it, And I don't think that anybody's. I'm not gonna paint the picture of anybody being ugly, or doing anything unethical or things like that. One person raises the rates, then everybody else starts raising the rates.
Yeah.
The rental rates.
It's economics. It's
Sure.
supply and demand.
Sure.
And so any business that's going to stay in business is going to try to do their best to have that price and demand kind of line up, right? So
do you feel like it's completely supply and demand?
Yeah.
I mean,
So I don't think it's completely. So here's what I'll say. So you got to understand how commercial real estate works. Okay. All right. So with residential real estate, typically 99% probably of the loans, maybe I don't know exactly what the statistic is, but most of them are fixed rates.
Sure.
Okay. So for 20, 30 years, 15 years, whatever it is, it's your payment's pretty fixed, barring insurance and taxes, right?
Right.
But so overall, there's not going to be a major increase in that. The way commercial works is they're pretty much all adjustable rates. And the way it works in Texas is typically most commercial deals are 5-year fixed. They adjust. They're 5-year fixed again. Right. They adjust. Okay.
Right.
So what happens is because their rates have went up, they now, to keep the same margin, have to increase the prices to the person.
Sure.
So that's why rental rates, like a lot of it's going up, is because of the fact of one, it's supply and demand, but two, it's because they're rates. So I'll give you an example. I recently bought a residential.
Gotcha. Okay. But because this is bigger than the 1 to 4 multi, because a lot of you can use a residence.
Even the 1 to 4, because what happened is Fannie Mae, Freddie Mac, for instance, which is the majority of those that are going to be on let's not say 1 to 4, let's just say investment properties.
Sure.
So single family residential investment properties.
Sure.
What happened was, so FHA, VA, USDA, those have to be owner occupied. Okay,
right.
So you can't do investment properties with those. So you're pretty much going to go Fannie Mae, Freddie Mac, which is what I do, residential mortgages. So you can go that route, or you can go commercial.
Right.
Okay. Commercial lender can lend on a single family investment property. What happened was Fannie Mae, Freddie Mac said, I don't remember exactly when it was, middle of 2021 maybe. They were like, we have too much exposure to non-owner occupied properties. So we're going to add 4 points, and I'll hold me to all exactly that number, but 4 points to any investment properties. So basically it made it to where you're paying 4% just to get a 7% rate to go on a Fannie Mae, Freddie Mac. You're going to go commercial instead.
Sure.
So basically Fannie Mae, Freddie Mac priced it out to where they didn't say no, but no one was doing it. And I don't know why this is the case, but I feel like everybody and their mother had Airbnb, right? Or
Yeah.
and so so what they're
It
doing with
showed up
those,
everywhere.
yeah, and then what they're doing with those is they were getting the Fannie Mae, Freddie Mac loans on a 30-year fixed because that increases their cash flow.
Sure, definitely.
And so that's where they go. But now Fannie Mae, Freddie Mac basically has gotten out of the investment residential deal. Okay, so let's take my example recently. So I have a couple commercial properties and I have a residential investment property.
Right.
Okay, so I just bought the residential investment property a month or two ago. Now I just rented it out effective January 1st. What determined my rent? It was based on my interest rate. Was really kind of where I had to go because you have the cash flow if you want to stay in business.
Sure.
For the most part. And so if I want a cash flow with an interest rate that's where they are right now, then that's made what I like, went up $300 or
Sure.
whatever it is.
But does it work in the opposite direction though? So
no.
that's what I mean when I say the supply and demand. I agree with you on that side of it. Like, hey, I've got to set them here based on. There's no point in me getting into this if I can't make money. I get a chance to use that money to go do other things to make more opportunities for people to rent. I'm no problems, no qualms with that. But what I mean is like it doesn't work the other way. In that if the rates start to fall, you're going to see a decrease in rental rates because that has already been set. That
you're establishing that. You're used to paying that.
It's a new norm. Now it's established. And so part of it I get. Part of it I'm like, but that's maybe the capitalism side of it is that, hey, I'm going to try to get as much as I can for this because it does create new opportunities. If the rates do drop after those 5 years and, you're able to bring in more cash, you can put that towards a new purchase, be able to create another housing opportunity for somebody else. I don't have any qualms against it, necessarily. It's just funny to me.
Yeah, it does open it up. It depends on supply and demand. So if there's still limited supply and there's high demand and rates drop,
sure,
then the landlord, of course, is not going to lower the rent because there's demand there and they're just going to increase their margins.
Of course.
That's what's going to happen. And then any new or any upcoming, anybody that has rates adjusting or anybody like myself that are buying a new property, we have to value that property based on the current reality of where rates are at. And so you're gonna have that. But a lot of it is to do because even on my end, like I would much rather charge a much lower rent. You just can't do it. It's just it's not possible.
Sure.
And you're charging market rent, and that's because the rate where I'm at with market rent is because I can tell you right now, rates is where the rates are. That's where the market rent has to be.
So with that, kind of piggybacking off that, do you believe? So I'm starting to hear more people utilize adjustable rate mortgages. Do you think that's a good opportunity for this time period?
No.
For a residential homeowner, do you think adjustable rate mortgages are a good idea for this time?
For the most part, no. Like the pricing on them are just not beneficial compared to where the fixed rate is still. Now, every person's situation is different, and if it's something that you're going to be in that place for only X amount of years for sure, and you're comfortable maybe getting a little bit of a better rate on that end of it, it's possible.
Yeah.
I like mitigating. I believe in mitigating
Me too.
risk.
I'm right there with you.
And so therefore, if I have a choice between the known and the unknown, I'm always going to choose pretty much usually the known.
Yeah.
Because I can project out with more accuracy of where that's going to be.
Sure.
So I actually talked to somebody about this actually today. They were talking about going the adjustable rate mortgage route, and they did it before and it worked out really well for them.
Mm-hmm.
But here's an example. Okay, so I don't do construction loans, but I always recommend, and this was long before rates went up or whatever, that if you have a choice between a one-time close, 1.5-time close, or 2-time close. So construction loans, to kind of give you an example how it works, you have your interim financing. That's the part where you're drawing out the money and you get to the draw out and then your house is finished. And then what you do is you refinance and put it into a permanent long-term loan, basically.
Right.
Okay.
Right.
So I always recommend doing a 2-time or 1-time close, because on a 2-time close, let's say it's January, February, March of 2022.
Mm-hmm.
You start the you get the loan, you're at a 3% interest rate, 3.5% interest rate, and then the house takes 8 to 9 months to complete. And now here you are there, and then you have to get the second time part. You got to get the permanent financing put in.
Right.
Well, when you qualified and you originally got that rate at 3.5, now rates are 7.5.
Got somebody going through that right now.
There's a lot of them going through that, and it's because a lot of people don't know about a one-time close option.
Right.
And so you do that. Now the benefit of that is, okay, you do a one-time close. Well, they're sitting pretty. They're happy with themselves.
Sure.
I mean,
sure.
they're doing that. But on the flip side of things, well, what if the rates fall? Well, you can always refinance.
Right.
I mean, even once it's finished, you can
Come back and
refinance it. So the one-time close mitigates that risk. And so an adjustable rate mortgage, with even absolute certainty, it still puts you at odds and a risk that you don't know what it is now.
Sure.
So if the choice was ever given, and unless there was a major difference in savings, I would always choose the fixed rate.
Got you. Any innovative loan products or anything that Guild, you feel like would be good for people to look into right now?
Yeah. So Guild, I'm excited about this. We have couple of things that we're doing right now. One thing is that anybody that purchases, and I don't have the deadlines right now on me, but anybody that purchases right now, and they will, if they buy with us, and then within a certain time period, if they refinance with us, we will waive the lender fees.
Oh, okay.
And so that'll save them. So instead of when you refinance, I mean, you got to pay fees again. You got lender fees, title fees, all different fees on that, appraisal fees. We waive our portion, which is going to save you about $1,400.
Nice.
So where other lenders, they'll put you in a purchase or whatever the case is, you're going to refinance probably, in a couple of years, 2024, let's say.
Mm-hmm.
You refinance, you're going to have to pay those lender fees.
Right.
So we're saving them right out of the bat, $1,400 for if you were purchased with us right now.
Nice.
And the fact that you plan on refinancing.
Nice.
The second thing that we do, the program that I like that we have, and I've done a lot of these last year, were the 321 321 Home Plus or something to that extent. I can't remember the exact title of it. But what it is it's for the first-time home buyers that are within 80%, 50 to 80% of the, or 80% less than the area median income.
Gotcha.
Which a lot of people, if you're within that part, we'll do several things for you. One is we'll give you a grant, so free money, of about $1,250 to I think $2,500.
Is that something that is that something that you have to stay in the house for a certain amount of time?
And so that money is given to you at closing.
Wow.
On there. The only thing you have to do to get that grant, that $1,250 or $2,500, is you just have to complete a homeowner's education course, which I think is good for anybody.
Yeah, definitely.
But it's $100.
Oh my gosh.
It's an out. You spend it. You do it in the comfort of wherever you're at. It's online. It's $100 for an hour, and you get the certification that you've completed it. You'll learn a lot from it, and then you get that grant. So free money of $1,250 to $2,500, and then the other benefit of that too, on top of that, is we'll give you the grant, and then you get $1,250 to $2,500 free money.
Mm-hmm.
Then we'll give you a $2,000 Home Depot gift card after closing.
Hey, oh my gosh.
So I mean. And
that goes a long way. I mean, things you're gonna, even maybe if you're just filling nail holes in the wall. Yeah. When you're coming into the house or buying doorknobs, of course, I always suggest, hey, first thing you do, you get into the house, change the entry doorknobs. The locks. Let me say the entry locks. That way, nobody, there's no keys floating around out there. Who knows what could happen this day and age. So that's pretty. That's amazing. That will cover a lot of things.
Minimum, like let's say $3,250.
Yeah,
is what you're getting.
Nice.
No one can touch that.
Sure.
If you qualify for that program, it's a great program,
sure.
Free money, and so you have that. And that's really the Guild things. We offer a bunch of different products.
Sure.
We do the rate buy down too. Which is kind of really more gimmicky than actually beneficial. And
I've always appreciated everybody over there at Guild, Harold, yourself, now willing to when other lenders may fall short, y'all's ability to come in and say, hey, let me at least look at this, see if I can help.
Yeah.
I think y'all have done a great job over there at Guild of, helping where other lenders probably could not, know.
I mean, if you ever are denied or not qualified for any, like, I would always recommend, contact
Sure.
us. My phone number 903-215-0451. Contact us, have us do a second look, because I can tell you right now, like I'm doing one right now. He applied today, and I was talking to a realtor,
Mm-hmm.
and he told me about how he had this one borrower. They wanted to go VA, and I'm like, well, which lender? What lender are they going with? Oh, they're going with the bank that they've been with forever.
Sure.
And I came from the bank, and so I was like, listen, I guarantee you they didn't. What they told him was his credit score was too low. Okay. I was like,
for them.
And so I was like, I guarantee you, they told me he had to be a 620 credit score.
Right.
He said, yeah, that's exactly what they said. I was like, VA has no minimum credit score. VA has no minimum credit score.
Really?
Mm-hmm. So there's that tells me, so what happens is, and the thing to keep in mind is banks and lenders have what's called overlays.
Sure.
So they have additional rules that they add,
of course,
because they don't want the risk of having to, what they have to do is called buy back the loan.
They want their specific client.
I want to say that they don't want to risk buying it back. So what happens is, if I take the loan, we underwrite it, and we sell it to FHA, okay? And if I sell it to FHA and FHA comes back and they audit it, and they say, you know what, you missed something, and so you're going to have to buy that loan back. It's very hard on banks to have to buy back a government loan, because banks do not do enough volume of government loans to be able to retain servicing on those loans.
Sure.
Where like Guild, because we are a direct lender for them, and we service our own loans, if we have to buy back, it's not good. We don't try to do that. But at the end of the day, we're able to put a little more risk out there, because hey, if we have to buy it back, it's just part of doing business.
Sure. Where
banks, they really can't. It's almost, so they put that 620 minimum in there. And then a lot of times, if they are doing it, if they're doing government, especially as the bank, they're selling the servicing.
Sure.
So a lot of the big reason why to go to bank is like, hell, they'll be my mortgage servicer.
And that's not
the case if you're going government.
And I talk with a lot of people about that. And what I mean, I guess, by when I say, they're looking for their specific, customer, their specific client, is that risk. Like, hey, I feel like these parameters, if a person falls within these parameters, then my risk of having to buy that back decreases. So my person that I feel the best in taking that risk on looks like this on paper. Mm-hmm. So I oftentimes, and I tell people, listen, you got to shop around, specifically because, for one, in our sitting down with a potential buyer, I can't give you everything. But if you start going to mortgage lenders, and I especially encourage shopping around, because you're going to have a different experience with everybody. And not only do I believe interest rates make your decision, but also your comfortability. Sometimes you're just not comfortable with somebody. It has nothing to do with either person being bad or good, or this lender is a crook or nothing like that. I'm just saying, hey, I walked in, we just didn't vibe. Mm-hmm. I think all of that is part of the buying experience. So I say, hey, go shop around, for one, because somebody may be able to educate you on something that you just didn't hear, from any other person. So I always encourage, when somebody comes to me, hey, I'm looking to buy a house. People that I've worked with before, I know that will do right by you. I'm going to send you a list of names. You need to apply with at least 3 of them. Apply with at least 3 of them. See what happens. See what kind of raise you get. We're all competitors. I'm competing against other agents. And if I'm going to send somebody's name out, especially as a lender, I'm like, hey, I want to know that you like to compete as well. You may not get this one, but you may get the next one, depending on, the client and everything. So all those things, I feel like everybody that I've worked with at Guild has done a great job of, like, hey, I'm going to put my best foot forward and getting the client what they need, listening to the client, not being, pushy, not just trying to sell. That honestly, that kind of bothers me more than anything, when I feel somebody that's just trying to get a deal. I understand we all need to make money. But I literally I literally practice my business in a sense of I'm going to just do my best here with this person. And if I do great, then I'll most likely get paid, So I always appreciated that about Guild Mortgage Company, period. And I feel like you kind of fall in that same vein. We hadn't got a chance to close a deal yet, but I feel like one is coming. And moving into some of those things, those values that you instilled, you're wanting to instill into your children. We talked about earlier in the podcast. I recognize you retain those as well in yourself. 40 under 40 nominee, I believe, finalist, not nominee, finalist. What was that experience like for you? Did you go to don't they have like a little dinner and everything?
Yeah,
How was that for you?
Yeah, I was a 40 under 40 finalist for banking and lending, and they do a finalist. They do a dinner for an evening or whatever.
Sure.
It wasn't really.
Did you know who won before you got there?
No.
Oh.
So you don't know. I believe the people that won knew, because I don't know, because like they did a spread. They had a magazine ready for them. Maybe it was a part of. We submitted About Me. I guess I could take that back. So we submitted About Me. We as a finalist, we submitted About Me to them, and I guess that's what they used for that.
Oh, gotcha.
So no, you don't know. So I'll take that back. So you go to it, and you don't know who's gonna win. They call out the category, and they basically say, give the names of who's the finalist, and then they say the winner is, and then that's how.
Were you nervous?
I wouldn't say nervous. I was excited.
Yeah.
I mean, it was an opportunity. I just was thankful for that, and that the fact that East Texas View would actually put that program on to help highlight and spotlight us. So no, it was an honor to be there.
Sure.
And
the fact that so many people.
Yeah. I mean, it's a peer voting system, right?
Right.
So, I wasn't fortunate enough to win, but what all that meant to me was I just need to help more people.
Yeah.
So, just need to help more people.
And that you're going in the right direction.
Yep, going in the right direction on that.
2019 Affiliate of the Year.
Yeah.
Longview Association of Realtors.
So Longview Association of Realtors, 2019 Affiliate of the Year. Basically, anyone who's not a realtor.
Sure.
They fall under that real estate category. They're an affiliate.
Right.
And so that to me, like that winning that probably is the highest achievement that I've gotten in real estate to me. Like, wow. Because that's voted on by the Longview Association Realtor members specifically. And so they were able, that's coming from peers, but people that's in your industry.
Sure.
And I had no clue on that. And the Jessica Holmes, who was a realtor, that she just came off as the chair for them, she invited me and said, "Hey, will you sit with me at the table?" And I had no idea, and she knew, and it was like I was like, "You tricky," but,
that's great though.
And so I was that was the most surprising award, and I was very honored to get that. So thankful for that.
Man, serving on Kilgore College Foundation Board, Boys and Girls Club. I'm trying to paint the picture of somebody that's invested in the community. And I just saw recently, I don't get onto News Journal a whole lot. Sorry, News Journal. But when I do, I just so happen to pop up and say, "Oh, I know this face, running for city council."
Yeah.
What made you decide to do that? Now, this, of course, isn't a political show or anything, but I do think, let me say this to be clear. When I bought a house, I realized like I was, as much as I was vested in the community before, I'm bought into the community now. Yeah. So everything that's going on around is affecting me, and affecting my ability to be a husband and a father. So whereas I'm not a political person, I do recognize that politics or involvement, I guess the city council member may not be necessarily as political as other positions, but all of that is affecting where you live and how you live. So I think it's important, especially now that this is your first bid. I'm assuming your first time running for city council.
Yes.
So your first time. I think it's important, people hear who's running for these positions. So what sparked this? What sparked you desiring to run for city council?
So what sparks it is like I tell people I'm not self-made. I'm community-made.
Sure.
And so I'm a product of Longview Public Schools.
Yeah, you owe us.
I do. I'm a product of Longview Public Schools. I'm a product of the community and everything that has been helped me so well. And then with that, like, I want other people to be able to have the same opportunities that I did.
Sure.
And that's why with the Boys and Girls Club, that was like very passionate to me, because I wanted to help give those opportunity for, I mean, my mom was a single mom. And so I know that safe childcare was important to her.
Right.
And I know that impacted a lot of her stress level, that we had somewhere safe to go after school because she had to work.
Sure.
And so the Boys and Girls Club, having that ability to do all that stuff. My wife serves on the Asbury House board.
They're awesome as well.
Yeah, and they give they give quality preschool education to the kids there. And then with my own kids, having my kids Vivian 7, and then my son Talon, who's almost 5. He turns 5 in February. My wife and I were lucky to be able to get back. So we were gone for 9 years, and we're basically boomerangs in the sense we were able to come back, but we're so thankful that we were able to come back because we were able to get jobs.
Sure.
And the different things that were here for us. And selfishly, I want Longview for my kids to be someplace not only that they want to be, but they're able to be where they want to live.
Yeah.
And that they can reach their full potential with that. So really, it's just really the aim of just building a better community for a better future for our community, for the district, and for the city.
Sure. What are some things you feel is important that you would be able to address or help address as a city council member?
Yeah. So one thing about me is I bring my financial knowledge to the council, and so we have a great city council. But when Ed Moore, who was a city councilman before, he's rolled off, there's not really much of a fulfillment there. So I feel like I can add a lot of value with my financial knowledge and background that would help the council a lot. And then also, as a loan originator, as a loan officer, my job is really like, the borrower comes to me, tells me what they want. Here's what my goal is, and here's what I'm trying to do.
Right.
And that, that's the constituent. Okay. So they're coming to me, it's like, hey, here's what my issue is, or here's what I want, here's what my goal, whatever the case is. I'm like, okay, great. Now, how can I put this together that we can meet regulations, guidelines, right?
Sure.
How can we put this together to be able to make it where we can do what you're trying to accomplish and do that? And so now I'm being a guide for them. I'm an advocate for them. And then I'm helping them and informing them and being knowledgeable about everything. Now I got to, I'm not the final approver. I rely on an underwriter that makes that decision.
Right.
So I got to get the underwriter on board.
Sure.
So then it's consensus building, right? And that is tailor-made what a city councilman or woman does, right?
Right.
Is that. So that's what I do for a living. I love the customer-facing aspect of it. And my financial background, I think all that will bring a great ability to further do what the constituents want.
Gotcha. Are you running against anybody right now?
Don't jinx me, Mike.
I know. I'm sorry.
As of right now, I am running unopposed.
Okay.
But I take it very seriously.
Sure.
And so I need everybody's support.
Sure.
However which way you can give it to help to get my message out there to the voters, and then also to help just put me in the position.
Maybe off. How does that work? I mean, did you have to talk your wife to get on board with this? Because of course you're not doing this on your own.
No, not at all.
And Ms. Nustad seems very supportive. Was it something y'all kind of had to talk, to get her on board, or was she pretty supportive for you in this?
She required no coercion or other means to get her on board. No, my wife is my biggest supporter, my biggest champion for that, and she encouraged me and all that stuff and everything. Because at the end of the time, we still have young children.
Sure.
And it's going to put extra, duties and pressure on her responsibilities, but she's, you know, I married up.
Yeah.
And so she,
Me
like,
too. I know the feeling.
Trust me,
we're rowing in the same boat, buddy.
She gets it done. So there's nobody more capable on that end of it. So
Sure.
No, she's definitely my biggest champion.
That's awesome. That's awesome. As far as man, I for one, I really appreciate your time. You coming through today. And as far as people being able to find you as an agent, as a lender, loan officer, let me be more clear, as a loan officer, and then also in anything you may have out as far as your city council run, how can people find you?
Yeah. So as a loan officer or anyway, my phone number is 903-215-0451. Again, 903-215-0451. My website for city council is johnnustad.com.
Gotcha.
So as long as you know how to spell my last name, you're good.
Spell that last name for him.
So it's John with an H, and then Nustad is N as in Nancy, U as umbrella, S as in Sam, T as in Tom, A as in Adam, D as in David.
Gotcha.
You can tell I do that a lot.
Oh man, let's see.
And
I would struggle.
One thing, some people understand it, it's always a running joke. It's the car Dotson backwards.
Oh yeah.
So
interesting.
So that's the way to spell it. If you know what a Dotson is, you know how to spell Dotson, then you can figure out my last name. And as far as for my website, it's guild.com, I guess, / John Nustad, or guildmortgage.com. I can't even remember off the top of my head. .com/John Nustad. So sure. You can easily get there that way.
Awesome. And you can be found on Facebook. You guys are interesting. Follow on Facebook. You put up a lot of information concerning, the nation and find your financial background. Definitely, because a lot of times I can't even follow, what you're talking about. I'm like, okay, let me go do some more research. Go type this into Chat GPT and have him break it down for me.
Yeah, I try to. You can follow my Facebook page. I'm on there too, both of them for the council and the mortgage. On the council side, I try to be informative, and I try to be a source to help my referral partners,
right.
And everybody, even my homeowners, that they can be informed on that. So very much about helping, not very much about myself.
Sure.
I keep it kind of where, hey, it's not about me.
Yeah.
I'm just the guide.
Right.
My job is to help my referral partners and my borrowers.
That's awesome. Any special events or anything coming up? Any announcements you need to?
Yeah. So I do have a meet and greet for my city council. It's coming up on January 26th. It's 5 to 7, and it's going to be at the new location for Longview Museum of Fine Arts.
Oh yeah.
And
where are they moved?
I think it's 206 North Fredonia.
Oh, that's right. That's right.
I believe is the address, but again, I don't know off the top of my head.
Sure.
But the events on Longview News Journal, I have it up there, and then also I'll make an event in Facebook and share that out. Anybody that can come by and support and just want to whatever, that's fine with me.
That's awesome.
Good. I'll be glad to have you.
Awesome. Well, hey man, I appreciate it, John. This is season 2, episode 2. Thank you so much for checking out this video. You'll find a lot of great information in the description, how to reach Mr. Nustad here, and all of his information I'll link at the bottom of the video or in the podcast description. However you're watching this, however you're listening to this, please share. We're trying to grow as quickly as possible, get more information, and talk to a lot of interesting people in East Texas. All right, thank y'all so much, and we'll catch you on the next episode.